Hey guys, it's Sean from Guaranteed Rate. We got a mid-November 2021 market update. I can't believe it's almost the end of the year. Thanksgiving's right around the corner next week. Christmas and the holiday season is right around the corner. Seeing Christmas lights up. The weather's getting cold and crisp, but certainly what's not getting cold and crisp is the real estate market. It is super hot. Open houses are busy. I'm seeing, on social media and talking to my realtors, lines down the street of cars at these open houses, lines waiting to get into some of these open houses. So the activity levels out there now. Certainly, we're not seeing the bidding wars and the multiple offer situations that we were seeing in the spring and the summer, but it's a super active market. So here's what we got. We're going to cover some mortgage application data, some of my observations in terms of the refinance and purchase activity we're seeing. We're going to talk Fed tapering, the Zillow news that came out, the employment report, and the infrastructure bill. We're going to try to get out of here in a short amount of time, so pay attention. I talk fast. Applications to purchase a home rose 3% week over week. Year over year, purchases are still down 4%. But last year, as a reminder, October, November, December was super busy because we didn't have a spring market in a lot of cases when the pandemic first happened. So that got pushed into the fall. On top of that, what happened last year was the motivation to move, bigger homes, work from home space, remote schooling, more space. We saw a big push from urban markets in the suburbs, and it happened fast. So last winter and fall was super busy. So the fact that mortgage applications are only down 4% compared to an extraordinary year is super impressive and shows how active it really is. I know it's one of the busiest fall markets, actually the busiest fall market we've ever taken a part in. Okay. Now, the other thing to consider is that even with considering that applications down 4%, there's other two things. Okay, one is 1 out of every 5 deals across the country, 20% of deals is a cash buyer. People are paying cash when they have the means to do it in order to help win a house. Okay, it's because inventory is low, multiple offers, tough competition. They're trying to make themselves appealing by paying cash. In a lot of cases, they're doing mortgage financing after the fact. We helped a lot of our clients out with that in terms of doing delayed financing deals. So if that's something anybody's interested in, wants to find out, hey, if I do want to go with a cash offer and do delayed financing, I'm happy to talk to you about a strategy and how to prepare for that to make sure there's no surprises when you try to take the cash back out. The other thing is, inventory is down 13%. So what happens is, when inventory goes down, that leads to a decrease in mortgage applications. The motivating factor for a lot of consumers to apply for mortgages when they see a house they like that suits their needs. Now, I don't recommend waiting to get pre-approved until you find the perfect house. Okay, it's much better idea to get prepared and be ready to go into the market 3 to 6 months in advance. Know your numbers. Let us tell you about the programs available, the product options, budget for you in terms of monthly payment, down payment, purchasing power, comfort zone, closing costs. Like knowing, they say knowledge is power, and that's certainly the case. In a tough, fast-moving market that can be intense, it slows the process down, eliminates stress and anxiety when you know your numbers. So do not wait until the last minute. I know sometimes that's just the way life works, where we get calls on nights and weekends and sometimes hours before an offer is due, sometimes when the offer is being made, and we're happy to accommodate those, and we always will with a smile on our face, and we'll always come through on it. But if you can get prepared in advance, definitely do so. Some other stats: home prices are up 20% year over year. So what's that mean? That means that a house that was on the market last year for $500,000 is worth $600,000 today, right? That means that a house that was $1 million is now $1.2 million, right? So home prices are up across the country, and that's expected to continue. Maybe not at a 20% clip. It seems to be the forecast we're seeing for 22. We're seeing anywhere from a 6% to 9% home price appreciation. But there wasn't also a lot of 20% predictions last year, so going into this year. So it could be more, but so far we're seeing 6 to 9% home price predictions for 2022. Rates are up about 1/8 of a point year over year. They're up a little bit more than that from their lows earlier this year. Right now, to kind of give you guys an idea, rates on a 30-year fix are hovering right around 3%. However, we have a lot of clients getting rates better than that, both in jumbo and conventional loans. Our best rates that we're locking in with no points are anywhere from 2.75 to 2.99, depending on the type of deal. Certainly, those clients getting rates higher. It's all based on your down payment, product type, credit score, things of that nature. 15-year mortgage rates are in the low twos. We're seeing 2.25, 2.375 in the best case scenarios. There's certainly options in order where you can buy rates down. There's also options at higher rates where we can cover closing costs. So it's important. It's really difficult to quote rates, and these aren't rate quotes. I'm just giving you some information and observations of what we're seeing. We are anticipating rates to be in the mid 3 to 4% range. That's what we're seeing based on what the federal government has announced, a tapering of their mortgage-backed security purchase. That should be done by June. So that's when we think rates will be in the mid 3s, and we're seeing some predictions even calling for rates on a 30-year fixed rate to be around 4% by the end of 2022. So that what that leads to is lost buying power, right? So for if rates go up a point, you see an average client lose about $50,000 in buying power. That leads to higher monthly payments. Now, if you factor that in with home price appreciation and rates going up, waiting is only going to be more expensive, and it's going to be, housing is going to be a bigger part of your budget next year. And as home prices appreciate, a lot of times they appreciate faster than you can even save to prepare for a down payment. So I think getting into the market now, especially in a market that's kind of quieter in the fall and the winter than it typically gets in the spring, is huge, in my opinion. So if you're waiting to time the market, you might be waiting for a very, very long time. Refinances rose about 7% last week. There was a little bit of a dip in rates last week from the week before. So we saw some people that maybe hadn't gotten their refinances done, create a little surge in that. Refinances are down about 28% from year over year. It's because a lot of clients have taken advantage of refinancing 1, 2, or 3 times already as rates have continued to steadily decrease from 2018 to 19 to 20 to 21. We have some clients that have refinanced 4 times or 5 times already, chasing kind of rates all the way down. So if you haven't refinanced in 2021 and you're interested, if you want to check off the list of, hey, did I do an annual mortgage review? Am I in the best possible mortgage for myself? Definitely let us know. We're happy to discuss if we can save you money, eliminate PMI, lower your rate, shorten your term, review some cash out options, etc. There's many different options out there. It's not one size fits all. It's all based on your specific needs. One other interesting stat, okay, national equity levels have increased 29%. So that's different than home price appreciation. Equity is the difference between how much a house is worth and how much debt is on it. So that's, as consumers are borrowing money at cheaper rates, that allows you to pay the loan down faster. We've also seen an increase in people taking out, shorter term loans like 15-year mortgages where they even accelerate the principal pay down of a loan. So equity has increased 29.3% this past year. The average equity grew by $51,000 last year. So that means, that's what people have additional worth in their homes versus the debt they have on it. Some stats, you guys know we do business all around the country. We're licensed in all 50 states. Thank you to everybody who's referred us. We've gotten a lot of referrals from our clients to their family and their friends across the country, from realtors if they have clients relocating, financial advisors as their clients work all over the country, and a lot of great loan officers out there that have trusted us with their clients in states they're not licensed in. So we can help anybody, whether you're buying a residential piece of property with a purchase as a primary residence, second home, or investment, or a refinance, cash out, rate and term, whatever, we'll take them, and we're doing a great job with them. We're closing them super fast. In fact, we've never closed loans faster in the history of our team than we're closing them right now, and our net promoter scores have never been higher. So we got happy clients that are closing super quick. We're doing a great job, I think, utilizing technology and just making the process easier, and we're laser focused on continuing to do that into 2022. But I digressed. The average equity in homes is up 51K. Some of the things that we've seen. California took the cake with the largest increased equity, $116,000 increase in equity on average. Then we saw Rhode Island with 68K, Massachusetts coming in at a 74K increase, New Hampshire 55, Maine 37, Florida 46. We have this list. So if you're interested in where your state fell, send us a direct message and we'll get back to you with that number. All right. So that's that. My observations for 2022. Okay. 2020 and 2021 were definitely refinance boom years. You guys have heard me say that in the past. They were largely utilized by rate and term refinances, clients lowering their existing rates, eliminating PMI, shortening their terms. What we start to see happen in the second half of this year is a huge increase in cash out refinances for a couple different reasons. One, obviously, borrowing costs are cheap, rates are still low. The second part is equity levels have risen big time, 29% year over year. So clients have more equity, borrowing costs are cheap. Now, there's not a lot of inventory out there. So we're seeing a lot of clients say, instead of moving, I'm going to stay where I'm at. I'm going to renovate my house and do home improvements. We're also seeing people do debt consolidation. whether it's paying off credit card debt, high interest rate credit card debt, paying off student loans. We're seeing other clients utilize their equity to get ready to buy a second home or an investment property. With inflation really kicking up, things are getting more expensive. So sometimes the greatest asset that people can dig into rather than diving into a 401k loan or borrowing or liquidating investments or just utilizing their cash reserves is accessing their equity to pay for some of those things. So cash out refinances are on the rise. I think 2022 is going to be the year of the cash out refinance as Americans across the country utilize the equity in their homes to pay for life's needs. Okay, so that's what we're seeing. The spring market's going to be hot. 2022 is going to be super, super hot. Okay, that's what I'm telling you. It's not going to be any different than this past spring market. Here's why. Rental prices are up anywhere from 8% to 16%. Okay, so bottom line is owning beats renting, and renting is becoming even more expensive. Okay, so mortgage application data has remained strong. That just shows the demands out there. There's still a massive motivation to move as life has changed over the last 18 months. There's still a big push to remote work. There's still a demand for more space. And frankly, there's a big demand for certain rural markets, second home markets. So just there's a lot of people that got boxed out and didn't buy a house in 2020 or early 2021 as the market's been so hot. Those people are still out there. And then, income across the country, especially in certain sectors like finance, biotech, tech, there's a lot of cash out there, and income as wages have increased, is being put to use. So it's as home prices have gone up, income's gone up as well. So it's not really prevented people from, not being able to keep up with the increased prices. Obviously, inventory, as I just said, is still a major issue. It's down 13%. Okay, so that's going to create, that surge to buy, that demand to buy, the motivation to move quick. Okay, borrowing costs are still super cheap, although I think rates will be higher in 2022. They're still pretty amazing compared to historical rates. Anytime you can borrow money in the low threes, especially with inflation, being up in the 5 to 6% range, is a great deal. Okay, the overall markets are up. We're seeing stock markets constantly set record high. That creates confidence. People, their investments are doing well, 401ks are doing well. It just creates consumer confidence as markets do well. And then, real estate's a hard asset, and it protects against inflation. And inflation is going to be a real major talking point in 2022. I think people will use real estate as a means, whether it's primary residences, investment properties, second homes, to try to protect themselves against, rising inflation. So my suggestion is, knowing the spring market in 2021 is going to be super hot, is get prepared now, get your pre-commitments in. It's a product that we offer to our clients at no charge. There's no obligation, but we will get your files fully underwritten, go over all the terms with you, allows you to close super quick and compete with cash deals and other really qualified borrowers, and hopefully put yourselves in a position to win. Grab the attentions of the sellers agents, and really just show that you're prepared, confident, and super qualified borrower. So ask us about our pre-commitment program. If you're a buyer or if you're a real estate agent that wants to have your clients pre-committed, definitely hit us up. What we're seeing in the current market right now, I think it's a good time to be in the market as a buyer and as a seller. Obviously home prices have appreciated, but we're not seeing at this time, like mid-November, I'm not seeing the crazy bidding wars. I'm not seeing houses sell. Obviously there's outliers, but in general, we're not seeing crazy bidding wars. We're not seeing, the 20, 30, 40 offers on houses. There's still definitely some stuff going up over asking. There's still some multiple offer situations, but it's certainly not as intense as it was in the spring and the summer, and that's normal. The fall and the winter generally is never as intense as the spring. Everybody always talks about the spring market for a reason. It's the spring market. I think also some buyers have taken themselves out of the market. They maybe got a little bit tired, right? I always say, a boxing match is 12 rounds, 3 minutes at a time, and then you take a break in between. It's normal, for people to recharge and get ready to go back in there. And that's what's happened in the housing market. People have taken themselves out of the market, whether it's to rest, maybe they got a little overwhelmed, get re-prepared, budget differently. Also, some people have renewed their leases, or maybe waiting for children to finish out school years. Everybody's or trying to figure out if their employers are going to be remote or back in the office, things of that nature. But that stuff should all shake itself out in the next few months. And I think you'll have all those people ready back in the spring market that didn't buy a house last year, or people that are ready to buy a house that maybe weren't last year. And then, a lot of the best inventory, a lot of times agents will wait for the spring market, knowing that's when they can sell a house at top dollar, and they're giving their clients that are interested in listing, that information and saying, hey, you might not want to put your house in the market, in between Thanksgiving and Christmas or New Year's. And so we're seeing a lot of that. A lot of people are getting prepared to put their houses on. So those are my observations in terms of what we're going to see on a refinance standpoint, what the spring market's going to look like, and what we're seeing in the market today. I think if you're a buyer, I think, if you can find a house that works for you between now and January, it's a great time to strike. All right. And then I'm going to give you guys some stuff we saw in the news and hopefully wrap this up for you here in the next 5 minutes. So the Fed announced that they're tapering in their last meeting, and it went into effect in November. They left interest rates unchanged, but they did announce their tapering plans. So they're going to start winding down their monthly asset purchases, what they put in place last year as a result of coronavirus. They tried to essentially stimulate the economy by driving rates down lower, and how they did that is they did asset purchases in treasuries and mortgage-backed securities, buying anywhere from $80 billion to $120 billion in mortgage-backed securities and treasuries a month. They need to unwind that. It can't go on forever. It's not healthy for our country and our economy, and taking on that kind of debt. So obviously winding that down and withdrawing from those policies was widely expected. They've been signaling it for a few months. They're on the mortgage-backed security side, they're going to unwind it by about $5 billion a month. So it should be over by about July. It's a good plan. They learned from what they did 10 years ago after the housing crisis. By slowly winding out, it doesn't create major shock waves in terms of rates spiking up, and it doesn't create economic turbulence. So I think good move, largely expected. Rates will rise as a result of it. As the Fed, the biggest buyer of mortgage-backed securities in the market, removes himself from it, rates will gradually go up, but that's okay. That means the economy is not an emergency situation anymore. Housing market's strong and stable, all good things. So Zillow, they announced they're stepping out of their iBuyer program, where they would buy houses in cash, streamline the process, renovate them, and sell houses, right? They cited construction, renovation, and closing labor shortages and supply chain issues as the reason they got out. Obviously, huge loss for Zillow in terms of economically and the cost that they put into that, as well as, unfortunately, 25% of their workforce is going to be released. My take on this is a couple of questions we got. Well, how's all those homes hitting the market going to impact things? There are 7,000 homes are going to go on the market. One, it's less than 1% of the homes in the entire 1% of the inventory, right? That's how much it's going to impact the market. So I don't think it will have an impact on the market where there's such a shortage of inventory. Two, they're looking to sell it to institutional investors, somebody that's going to come in and buy them in big chunks. So I think some people will come in and buy those and convert those into rentals, similar to what Blackstone did after the last housing crisis. But I don't think you're going to see a big impact in terms of like, hey, this is going to flood the markets with inventory. That's number one. Two, my big takeaway from it was how important a real estate agent is. It's really difficult to rely on buying homes, and if the Zillow thing shows it more than anything, you can't rely on technology and algorithms and all that kind of stuff to negotiate the purchase of a house. I think having an amazing real estate agent is super, super important and can be a game changer, especially in a difficult environment where there's increased prices, low inventory, challenging ways to negotiate. So that was one of my big takeaways is, although tech will make things more efficient and easy and lead to a better process in a lot of cases and shorten timeframes down, hopefully improve service level, it can't replace the amazing work that top-notch real estate agents do with their experience and their skills and negotiating power. So if you're a consumer listening to that, that's my takeaway. You're not going to see an influx of inventory. You can't replace having great service and support when buying a house. We saw a strong employment report last week. The employment numbers is something the Fed's been watching to kind of figure out how we go forward. I think it's important for you to know. Overall, strong employment report highlighted 530,000 new jobs. Unemployment rates down to 4.6%. It edged down to its lowest level since March of 2020. So we're getting close to where we were before the pandemic. Labor participation continues to be a huge problem. Not enough people are back to work yet, and we also saw this weird report where a record amount of people are actually quitting their jobs, which we're going to dive into more. But Obviously, we're looking for the unemployment numbers to go back down, and obviously not hoping for people to quit their jobs. But what it's resulting in is, since there's a labor shortage, wages are going up as employers are trying to entice people to come work. So you're seeing income go up as employers have to, try to compensate people to get them to be motivated to work. Average hourly earnings were up about 0.5% month over month in the latest report. And then yesterday, President Biden signed a $1.2 trillion bipartisan infrastructure bill into law. It included $550 billion in new spending for our nation's roads, bridges, ports, water, rails. It included $55 billion for clear water, $65 billion to expand broadband infrastructure across the country. Okay, this is a 5-year plan. It's not a 1-year cash infusion. I do think it's not going to help inflation. I think this will continue to spur inflation over the next couple of years. So that's not going away. We're going to be talking about inflation in 2022, 2023. They're also talking about another 1.7 trillion in complementary bill for social safety and climate policy. So there's a lot of cash. We're talking about trillions of dollars, not billions anymore, trillions. So it's definitely, I think the housing market is going to continue to run as home prices appreciate, because there's going to be a ton more cash infused. We're going to have some inflation. So I think we're in for a steady increase in home prices for years to come. And I think inventory will remain low due to supply chain issues and a huge demand. So keep that in mind. I think the employment numbers will continue to go down as this money gets stimulated into the economy. Somebody's going to have to do all these roads, bridges, water, rails, clear water, broadband infrastructure, all those things. Take humans to put them into place, and so I think that will help spur employment and income, but it is going to hurt on the inflation front. When you pump that much money into a system, it's got to happen. So I just hit you guys with a ton of information. I try to keep this to about 20 minutes. We're a little bit over that. I hope you guys all have a happy Thanksgiving. If you have any questions about anything we talked about, or if you want us to elaborate on anything, please direct message us through these platforms, or email me at shant@rate.com. Myself and my team will get back to you. Happy to come into real estate office meetings, talk to consumers directly. Anything we can do to help you guys. Bottom line is we're here to help you guys navigate this mortgage market and real estate markets. Have a happy Thanksgiving. Bye, guys.